Hey guys,
we're
welcome back. Welcome back to Elijah and Maxx Take Over the World with one Instagram Live at a time. Today, we will be discussing how we determine property value. Take it away, Max.
Okay, well, I brought my fancy glasses because I know you like to use a lot of fancy words, so hopefully they make me a little bit smarter to keep up with you.
Oh, your IQ just went up.
Yeah.
Perfect.
About 5 points.
Can I have some of those points? I could use a few of those.
Yeah, so tonight we want to talk about how the Goldfinger group establishes property value, like how we see value, both like on a pricing level, but also on a property specific value of like why do we like a property, why don't we like a property, and what we see in them. And I think the first point to cover is understanding the market. It's such a key indicator of how a property is going to perform because it's city by city specific. And if you look at our last Instagram where we kind of mentioned this, how some markets will appreciate, some will produce cash flow, so it varies. So if you're going to buy a property, before you go buy that property, you should really understand the market. And for us, for the Goldfinger group, we heavily focus on Los Angeles real estate.
Right.
And the reason why is because we really have a good understanding. I think you do, more so than I. You've been in real estate for over 10 years here.
I'm just older than you. Yeah.
I do have a little bit more gray hair in the back. But,
that's true.
But yeah, we have a very good understanding of the submarkets in Los Angeles and how they vary street by street, even within those submarkets, right? You have, on the west side, you have Santa Monica, Venice, Brentwood, and then you go into Mar Vista, you go into Palms. Like, they're changing so much just submarket to submarket and then street by street in those submarkets, which creates a huge difference in the rents and the properties and things about that market specifically.
And you go one street over in certain markets, it could change property values dramatically. If you go in Santa Monica, if you go north of Wilshire versus south of Wilshire, your rent differential is probably 10%. Would you say that's fair?
Yeah,
something around there. If you go west of Lincoln in Santa Monica or Venice, you're talking also probably 10-15% rent differential. You can get much higher rents in certain neighborhoods by just going a block or two, right? If you go in Hancock Park, you go east of Highland versus west. I grew up west of Highland. You go east of Highland.
The rich guy over here.
No, I grew up on the other side of the tracks. But if you go east of Highland, so one street could be a delineating border that goes from lower property values to higher property values, or vice versa. So knowing not just the market, the sub-market, and then what I like to refer to as the micro location, which is basically if you're on a busy street versus if you're in the middle of the block, if you're on the corner, if there's if you're on the street, there's a police station right across the street or a fire station, and it's really loud and noisy. It's everything. So micro locations are also important to be cognizant of when you're looking at valuations.
Exactly, because are you close to, you can be on a busy street, but are you close to great retail that makes it an attractive location?
Right.
Are you on a busy street and it's just a busy street with
right.
a lot of traffic?
And on that note, if you're buying an apartment building and there's great retail around, that could be a great thing. But if you're buying a mansion, you may not want to be in that busy corridor.
Exactly. And then the next component of understanding the market is the comps. What's trading in the area? What's the price? What's the price per unit? What's the price per foot? Really understanding that market specifically, because they change, especially in LA. These different submarkets, they trade on different multiples of income. So, a building making $100,000 in Santa Monica on a 15 GRM on a 15 multiple could be worth $1.5 million. But then you go, on the other side of the 405 and it becomes a 13 GRM market, and now it's worth 1.3. So it shifts, and obviously cap rates follow that. So I think the comps are a very important component of determining property value in terms of understanding, that market specifically. And then you can talk about, well, who are the buyers for that, right? Is it going to be a mom and pop owner who owns a couple buildings? Is it going to be an active investor who owns 10 to 20 plus buildings? Is it going to be an institutional firm that's looking for bigger properties? So I think understanding who the buyers are in that particular market can also affect the value.
Right. On that note, I would say that generally speaking, the smaller the property is, the bigger the buyer pool. And the reason for that is because there are more people in this world that have $1 than have $1 billion, right? And it's a very simple concept, but if you break it down into the investment space for real estate, there are a lot more people out there that have, $250,000 that could use it as a down payment on a, $600,000, $700,000 property. There's so many more people. I don't know what the numbers are, but you can only imagine how many people have $250,000 laying around versus how many people have $2.5 billion laying around. So as a very general rule, I always get, am I supposed to look at you or the camera or whatever? This is all just preparation for my Hollywood career. So anyways, the larger the property, generally speaking, the fewer buyers there are, right? So when you're looking at larger deals, like in LA, if you're looking at an apartment building that's 100 units, a lot of times that's institutional funds, that could be REITs, that could be some of these big conglomerates, these really big companies are taking out, and there's not as many of those as there are, mom and pop, or mom and pop, or whatever. Mom and pop, we'll just call it mom and pop investors. There's a lot more mom and pop investors that have $1 million, $2 million to put down than there are people that have $1 billion to put down. For sure.
And with that is also understanding, well, if there are buyers, what are they buying?
Right.
Like, what's the product type? To what degree are they renovated? How many units? Are they 2 to 4 units? Are they 8 units? Are they 20 units? Is it a mixed use? So I think, within the market itself, and it varies so drastically, is what is that product type? What are people looking for? So, which plays into the business plan of how we see value and how we determine value, which I think takes us to the next point of exit projections. I think the key way that we determine property value is saying, what is the building worth at its max value? Fully stabilized. Well, not my value, with 1x.
Well, your valuation plays a big role.
I always offer more because I'm a 2x guy.
That's right.
With 2x.
It's the maximum max.
Yes.
Can't get any more max than this.
Exactly. So I think what we do very well, through the investments that we've done is we've understood, well, what is the property worth at its max value, fully stabilized? What can we go resell it for if we reposition and stabilize the property? I think that's really where by understanding these markets, we found out what the true value is in the property. Because today, it's probably not at its best value.
Right.
And so we determine,
it better not be, otherwise we're not touching it.
For sure.
Yeah.
And by using kind of what we talked about, the rents, we're able to establish, well, what are the market rents? Are the rents below market? Are they above market? Like, really understanding the market helps us project, what it is today and what it could be in 6 months, in a year, in 5 years. And then the GRMs in those markets. For our exit projections, we're usually using cap rates and GRMs and saying, well, if this is what the income is at market, and to establish the value at market, we use our multiples for that area, understanding the market there.
Totally. I'm a better listener than I'm a talker, so why don't you just keep going?
I'll keep going. Well, you did bring up a good point.
Oh, thank you.
Not just now, probably.
Within the past few years that I've known, there was one good point that I did.
Is that, the true nature of what a property is worth at its stabilized value is typically an investor wants to buy it and have a steady stream of income. So they're buying for, the cash that they're going to be getting.
I don't remember the last time I had a steady stream. Sorry. Get back to
it's his Hollywood career.
I apologize, but just keep going. Is there a way to put me on filters?
I'll mute you.
Thank you.
I'll mute you. No, but you brought up this good point of that, somebody's going to buy a piece of real estate for what we discussed last time, based on appreciation, stability, and cash flow.
Right.
And so an exit projection means how much money is the next buyer going to make, is the next owner going to make if they own this property with the income that it's producing.
Absolutely. And the buyer may not be buying it for income, they can be buying it. We've seen deals that have traded where someone has subdivided a property and then the next developer comes in and then fixes up the individual parcels, or will fix up, sometimes you'll have people that will build a condo building and then another developer will buy it from them, do whatever they're going to do to the condos and then sell them off individually. So you kind of have to, for us, there's a differentiation between market value, which is what we're going to sell something for, versus our valuation, which is dependent and contingent on our business plan. So a business plan is how we're going to buy something, put a certain capital investment into a property, into an investment, and then reposition it or exit the investment, sell it at a certain price. So for us, that's a business plan, right? And that's our valuation is based off of our valuation of the property is based off of what business plan can we accomplish with that asset. And then the market value is not what we're necessarily going to buy something for, but what it's worth to the marketplace. And part of that of our disposition department is understanding who is the highest paying buyer, where are they hiding, how can we go find them, how can we illustrate to that buyer how to make the most out of the property after we're done with it and we've exhausted our business plan.
And I'm glad you made that distinction of, where we're buying it at versus where we see we can exit. And the way that we determine this, where we value the property in today is through our underwriting, which you like to use the back of a napkin.
Sure.
Any sort of scrap paper you can find.
Toilet paper, scrap paper.
It usually comes out better than my underwriting. But by knowing the market, by knowing what we can sell it for, and like you said, knowing our all-in costs, accounting for what it's going to take to get the property up and running. Sometimes there's a lot of deferred maintenance. Sometimes it has carpet from 1975. The 1976 carpet is much better.
Much better. Oh yeah.
And knowing what it's going to take us, the capital to reposition the property and get it to market, and then based on and also again, if you watched our Instagram live 2 weeks ago,
you should have.
And if you missed it, you can still go back.
If you watched that, you wouldn't have to watch this one.
We know our current investor appetite, what they're looking for in the deals and the performance on the deals. So when we're underwriting to establish what the value is today, we're baking in the profit margin so that we can get our investors their return. We get our fees based on this performance. I work for free. I don't think you do. I'm definitely, topic for a different day. But we know how much money the deal has to make, and so by knowing the cost, knowing our profit margin, knowing what it's worth on a stabilized value, on an exit value, we then can calculate, its value to us, where we can buy it today.
Right, our business plan.
Exactly.
Another thing I want to make a distinction, because the devil's in the details, right? We talked about market demand. There's a difference between market value versus demand in the marketplace. And the difference is that there are sometimes tenant bases that want something but are not getting it from the marketplace, right? So there may be a certain amenity, especially in this rapidly changing world where you have all sorts of apps and all sorts of new technologies that are coming out. So if we can deliver a product that is not in the market, so that the market is not going to speak to the demand for that product because the product's not in the market yet, right? So we have to supply that product to the market. So whether that means a certain amenity, whether that means a different service for the tenants, whatever that product is that we're going to deliver to satiate the demand in the market. So understanding demand is different than understanding what the market is. For example, you could have a certain market that no one has gone in there and put in, Ring doorbells, or whatever it is. Back in the day, no one had put in laundry into units in whatever market you're talking about. And now you're the guy that goes, look, people are paying more for laundry in Santa Monica. Now I'm going to start putting laundry into the units in Northridge, or whatever the market is that people have not started making that capital improvement for whatever reason. So
people in Northridge aren't washing their clothes.
I guess that's what I said.
That's what you said.
They wash their clothes. They have someone do it for them.
Yes.
But my point is that taking a look at the market and seeing the comps, right? It's important to see what the comps are so we can understand the market, but then take it a step further and go, what do people in that market really want, and how can we push the rents? How can we push the value, add value more to the tenant base, thereby increasing the property value?
Definitely, and that's all part of our cost analysis, right? Where we say, hey, in Santa Monica we're going to do this, in Venice we're going to do this, in West Adams we're going to, like, and I'm using these markets because this is where we own,
right.
and we say, this is what the market demands. This is how we can maybe push that market a little bit to increase value, which is all part of our cost analysis. So we say, hey, this is how much the building is going to take in terms of improvements, and use that in our underwriting to figure out, like, well, where do we see value? And I think the cost analysis is really what establishes our business plan in terms of what can we execute on, where can we exit if we're going to exit, or where can we refi if we're going to look to cash flow the property for a longer period of time. And the cost of this is really what's going to dictate our return. And so we usually do a pretty heavy analysis on the front end before we buy the property, saying, what is it going to take? What are we going to have to do? Is it going to cost $100,000? Is it going to cost $500,000? And a lot of this, I think, comes from our experience. 2 years ago when I started with you, I don't think I would have known these things right out the gate. But now, 2 years later, and your one good point, I definitely have a better understanding of, how we're going to execute our business plan and the cost of executing.
And about how people do the laundry in Northridge.
Exactly.
I want to just say that we don't know. I mean, we speak from our experience in putting in laundry into units and creating outdoor patios and converting units and doing all these kinds of things. We speak from what we've seen work in other places, and we look at how much we think it's going to cost based off of other projects, based off of construction bids, and then we also look at what do we think it's going to yield? How much more rent do we think it's going to yield? At the end of the day, like, we don't know. We can use comps. We could use our best estimates. We could do surveys. We could put up test ads to figure out, okay, how many more people are going to apply for this unit if we put up the ad with laundry versus, communal laundry versus in-unit laundry. So these kinds of things, we don't know with certainty. It's an art and a science. The science is looking at the research, the data, and past projects. It's those kinds of things. And then the art is understanding who's a tenant base, spending time in the neighborhood, talking to people, getting a feel and a gut feeling for what does the tenants and what are the people in this marketplace, what is their demand, what is their appetite. So I just think it's important for people to realize that we can talk about with confidence what we think and what we believe is going to work. At the end of the day, we do it based off of the information that we have, and then we pray that it's going to work.
Yeah. And like you're saying, it's so dynamic. I know pre-COVID, the big C, I don't know if we're allowed to say it anymore, but we were projecting rents, we were projecting a business plan and a timeline, and we've mentioned this before, we had to shift our timeline to say, hey, it may take a little bit longer, the city's working slower, it's harder to get people into properties, rents have come down a little bit. So there's things that are external factors that will always influence, what you just described, and you can't always account for them, and you don't know. And like you said, you can have all the experience in the world, but it's really a matter of the execution and what's the end result. Like, we don't know what the result is going to be. We have an idea through our experience, but
Right. I mean, if this was a plug and play business where you just, and you just did March like that, and then you got to the result, then everyone would do it. Part of this is having a gut feeling, an insight, and an intuition in terms of what's going to work and what the market wants. The other thing I'll say is that because I don't want to make it feel like we're just praying all day that it's going to work. I mean, I did put on the tefillin, but we're using data, okay? We're using projections that are conservative, meaning we're not saying, oh, someone's going to pay another $600 a month, like for a yard, when it's really only worth $50 a month, right? So we're being conservative with our projections on how much value we're creating, and then we're being conservative with the cost it's going to take, and then we're being conservative on the return that we're going to make off of that investment. So as long as you're conservative along the way, usually the model doesn't work. But if you're conservative, and realistic. And by the way, if it doesn't work, it doesn't work. If the model doesn't work, then it doesn't work. So if the model says, hey, we're going to break even on this, then it's just risk. There's no point in doing it. If the model says, hey, we're going to make a 20% return on making this patio, then great, let's go for it.
Definitely. And a perfect example of how this worked, we have a 9-unit building in Mar Vista that we bought last year in 2019, and because the state implemented this new ADU law that the city had to adapt, we're actually able to take it from 9 units to 11 units, which is an extremely huge value add to the property.
Yeah.
Tremendous. I mean, I think we did the math based on it's going to cost us somewhere in the realm of like $150,000 to $200,000 to add these 2 units, but it's going to bring in an extra $4,500 of income. And check my math. I don't have my glasses on, but it's a 14 GRM market. It's probably going to increase the property value $750,000. Around there, maybe a little bit less, but to go out and be able to spend $200,000 to increase the property value another 500 or so on top of that is tremendous. And this is we bought the property never even imagining this was possible. And so we do get creative in adding additional value, seeing things when we walk properties, when we are going in the units, like figuring out floor plans to establish like, well, how much more value is there in this property? And I think that's where we bring a little bit more to the table, is creating more property value than is just there in front of our eyes.
Right, and staying abreast of the laws and the markets and demand and what people are looking for. So if you're not keeping up with the market, you're not going to know about this ADU law. You got to be watching these Instagram lives. I mean, that's what you're doing here, right? So what else do we have to talk about? I feel like we kind of covered everything. Okay, we'll do a summary. How we determine property value, understanding the market, location specific. Okay, we talked about locations, understanding micro locations, delineating borders between going north of Wilshire, south of Wilshire versus and going west of Lincoln versus east of Lincoln. So we talked about how one street can make a difference of 20, 30, 50% of property value. We talked about rents in a market, looking over what things are renting for, calling up brokers, seeing, what did this thing rent for? How many applications did you get on that unit? So really understanding the demand for apartments or whatever the product type that you're looking at. Looking at the comps, understanding when we're creating our business plan, we understand who are we going to be selling to eventually down the road. What is the product type, degree of renovation? You wrote these notes. I don't know. Anyways, we talked about real estate, and we're going to keep talking about real estate next week.
Whether you want us to or you don't want us to.
Exactly. So we want to thank you for listening to our real estate talk with Maxx Feldman, 2 X's, Elijah Korobkin, the Goldfinger Group. We are very pleased and honored that you joined us today. We look forward to doing more Instagram Lives in the future. But
take care.
All the best.
Thank you.